Hey everyone, welcome back to Corporate Decoder, the place where we break down the nitty-gritty of corporate filings and find the real story behind the numbers. Today we're diving into OS Capital Corporation's latest quarterly report, and trust me, it's a tale of shifting assets and new debt. So, OS Capital Corporation, a business development company, just dropped their report for the period ending June 30, 2025. Think of them as a firm that invests in other companies, sort of like a venture capitalist, but with a specific focus. Let's jump straight into the heart of it, the financial tables. First up, the balance sheet, a snapshot of what the company owns and owes. As of June 30, 2025, their total assets stood at roughly $395 million, a bit down from around $428 million at the end of last year. The biggest chunk of that, their investments, saw a decrease from about $410 million to $383 million. This is a pretty significant drop, showing they'd either sold off some investments or their existing ones have decreased in value. On the debt side, they've managed to reduce their revolving credit lines from about $68 million to $63 million, which is generally a positive sign of managing debt. But their unsecured notes, which is like long-term borrowing, stayed pretty steady at around $17.8 million. Now, what does this mean for the average shareholder? Their net asset value per share took a hit, dropping from nearly $13 at the end of last year to just under $11 by June. This is a big change and usually indicates that the value of their investments has gone down or they've issued more shares without a proportional increase in value. Let's look at how they performed financially during the quarter. Their total investment income, which is the money they earned from their investments, was about $10.5 million for the 3 months ending in June. After expenses, their net investment income was just about $333 million. This number tells us how much profit they made from their core business of investing, separate from the ups and downs in the market value of their investments. But here's where the story gets a bit more interesting. They actually had a significant loss on their investments, a big chunk of which was due to something called net unrealized depreciation. Basically, the value of some of their investments went down on paper, even if they didn't sell them. That loss alone was nearly $9.2 million. On top of that, they also had realized losses, meaning they sold some investments for less than they paid, adding another $4.2 million loss. All in all, for the quarter, they ended up with a net loss of about $9.6 million. When we look at their investments in affiliated companies, the story is similar, with a substantial unrealized depreciation of almost $9.2 million. This highlights a concentration risk, as a significant portion of their portfolio appears to be in areas where values are volatile. This brings their total net assets down to about $146 million by the end of June, compared to over $72 million at the start of the year. It's a clear downward trend that investors will be watching. Digging into the schedule of investments is where we really see the details. For instance, their investment in Pfanstiehl Holdings Inc., representing a huge chunk of their portfolio, about 57% of their net assets. That's a very high concentration, meaning a lot of their eggs are in one basket. This investment alone had an unrealized appreciation of $82.8 million. While that sounds great, it also means if Pesta Holdings runs into trouble, OFS Capital could be hit hard. They also have significant investments in debt, like first lien debt in companies like Cred LLC and SS Acquisition LLC, forming a large part of their portfolio. It's important to note that many of these investments are classified as level 3 in terms of fair value. This means their worth is based on unobservable information, relying heavily on management's estimates and assumptions. This introduces a higher degree of uncertainty compared to investments' value using observable market prices. A big part of their debt portfolio, about 85%, is in first lien debt, which is generally considered safer as they get paid back first if a company runs into trouble. However, as we've seen, even these aren't immune to value fluctuations. It's also worth noting that all their international investments are denominated in US dollars, which simplifies things a bit by avoiding currency exchange risks. Now let's talk about interest rate risk. About 90% of their loan portfolio is tied to variable rates, generally linked to SOFR. This means when interest rates go up, they earn more, and when they go down, they earn less. Their report even included a table showing how a change in interest rates could impact them. For example, a 0.5% increase in interest rates could boost their net income by about $457,000, a pretty clear indicator of how sensitive they are to rate changes. Looking at recent developments, OFS Capital has been busy. They announced plans to redeem a significant portion of their unsecured notes due in 26, which is a move to manage their debt. On top of that, they recently issued new unsecured notes with a higher interest rate. This means they'll be paying more in interest going forward, which could put pressure on their net investment income, especially if interest rates don't increase to match it. Looking at their expenses, interest expenses did go down mostly because they've reduced their overall borrowings. However, their incentive fees, which are paid to their investment advisor shot up significantly from about $330,000 in the previous quarter to over $800,000. This is directly tied to their investment performance. So when they make money, the advisor makes more. It's also important to note that they have a number of loans on non-accrual status, meaning the borrowers aren't paying interest on time. As of June, these non-accrual loans had a fair value of about $15.2 million, which is around 4% of their total investments. This is a key indicator of potential trouble within their portfolio. So what's the overall picture for OF Capital Corporation? They're navigating a challenging market, and their recent financial results show that. Their net asset value per share has declined, and they've experienced significant unrealized losses, largely driven by concentrated equity holdings and a substantial portion of their portfolio being in level 3 assets, meaning their valuations are based on less certain inputs. While they've managed to reduce some debt and their interest income is sensitive to rising rates, the high concentration in PEFAN Steel holdings and the significant number of non-accrual loans are definite risks. The decision to refinance some debt at a higher interest rate also adds another layer of potential pressure on future earnings. It seems like OS Capital is taking steps to manage its capital structure, but the underlying performance of its investments remains a key area to watch. Alright, that's a deep dive into OS Capital's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.